In the year 2000, the most famous mascot in America was a sock puppet with a microphone. Everyone loved it. It was on the Super Bowl. It was a balloon in the Macy's parade. And the company that owned it lost money on almost everything it sold on Sidstick Stories. He'd say on purpose. 9 months after going public, it was gone. This is the strange part. The sock puppet wasn't the problem. The sock puppet was working. The business underneath it was designed from the first day to lose more money the better it did. This is Pets.com. Here's the pitch. And in 1999, it sounded like the future. The internet was going to sell you everything, and nobody had claimed pets. So a domain that had been sitting dormant since 1994 got bored. A CEO named Julie Wainwright got installed, and Amazon, the smartest e-commerce operator on earth, put in $10.5 million for a majority stake. When Amazon backs you, you are not a joke. You are a land grab. And there was a land to grab. Americans were reportedly spending north of $20 billion a year on their pets, almost. It's none of it online. So the money came fast. Venture capital. Then more venture capital. Then the big one. In February 2000, Pets.com went public, $11 a share, $82.5 million in a single morning. They took that money and did the most .com thing imaginable. They spent it on being famous. A $1.2 million Super Bowl ad. The sock puppet everywhere. And it worked. People genuinely loved the puppet. The brand was a hit. Which brings us to the only question that actually mattered, and the one nobody in that Super Bowl ad wanted to answer. What happens when someone actually buys the pet food? Because here is what the prospectus actually said, not the ad, the filing. In its first year, Pets.com sold about $5.8 million of merchandise. And the stuff it sold cost the company $13.4 million to buy. Read that again. They spent $13 to sell you 6. That is a negative gross margin. They were underwater on the products themselves before a single dollar of advertising, before rent, before the puppet's paycheck. Most failed companies at least make money on the sale and lose it somewhere else. Pets.com lost it at the sale. And it got worse the way physics gets worse. Their best-selling items were the heavy ones. Bags of dog food, boxes of cat litter, sold below cost and then shipped to your door at a price that didn't come close to covering the freight. So every time a happy customer ordered a £40 bag of kibble, the company paid for the privilege, which means the growth engine and the loss engine were the same engine. The better the marketing worked, the more orders came in. The more orders came in, the more money evaporated. The sock puppet wasn't selling pet supplies. It was recruiting people to help the company lose money faster. And on that model, they spent $42 million on marketing in a year. They made under $6 million in sales. Now, a business that loses money on every sale can survive exactly as long as someone keeps handing it more money. And in early 2000, that was the whole economy's favourite hobby. Except, and look at the calendar, Pets.com went public on February 11th, 2000. The NASDAQ hit its all-time peak on March 10th, 2000. That is 28 days. They cashed in the brand love, took their $82 million off the table, and the exact market that made it possible peaked less than a month later and began the longest slide in a generation. The tap didn't slow down. It closed, and a company that needed constant new money to survive suddenly couldn't raise a dollar. So they did what desperate companies do. They got aggressive. That summer, they spent another $10.6 million buying a competitor, PetStore.com. As if the problem was not enough scale. It was never scale. 5 months later, it was over. The stock that opened at $11 was trading at 19 cents. On November 7th, the board pulled the plug. Orders stopped 2 days later, 11 a.m. Pacific. 255 of 320 employees gone. From the IPO bell to liquidation. 268 days. Amazon, the smart money, wrote the whole thing off. In its annual report that year, the shareholder letter had a one-word line about its failed bets. The word was, ouch. And the puppet? The puppet was the only part that survived. In 2002, the rights sold for $125,000 to a subprime auto loan company who put it back on TV with a new slogan, "Everybody deserves a second chance," which turned out to be the truest thing anyone ever said about Pets.com. Because Julie Wainwright, the CEO whose name got attached to the whole disaster, took the one lesson the puppet never learned, that you have to make money on the thing you sell. In 2011, she founded a company called The Real Real, luxury resale, where the margins are real because you're not shipping cat litter below cost. She took it public in 2019. It was worth over $2 billion. So the real ending isn't the sock puppet in a landfill. It's the person everyone blamed, quietly proving she understood the business better than the market that funded her did. They didn't lose because the internet wasn't ready. They lost because they built a machine that turned sales into losses and then spent $42 million making it popular. Someday, there's always another one.